You have probably heard people say that artificial intelligence is just a software gimmick, something that lives in the cloud and does not really impact the physical world. Or perhaps you have heard the argument that it only benefits English speakers in Western countries. Well, what if I told you that right now artificial intelligence is actively preventing live payment fraud on your phone and deciding the exact route your delivery driver takes to get your groceries to your door in 10 minutes? We are currently entering what the technology industry calls AI Layer 5. This is no longer about building giant abstract language models in a distant laboratory. This phase is all about artificial intelligence in your hands. It is the layer where this technology embeds itself deeply and seamlessly into everyday Indian life. Why does this matter to you as an investor? Because while the general public is often distracted by the science fiction hype, smart money is looking at adoption. Today, a massive 87% of enterprises are actively experimenting with these applications. The year 2026 is emerging as the critical, high-leverage window to invest in application startups and established companies that are turning this raw technology into actual measurable revenue. If you are participating in the Indian stock market or looking at mutual funds, understanding this fundamental shift is no longer optional. It is essential for protecting and growing your wealth. Let us break this down with real numbers and real scenarios. Now, here's where it gets interesting. Look at how artificial intelligence is boosting user engagement right now. Applications like Healthify Me are using it to create highly personalized diet and fitness plans, scaling their services to millions without needing an army of human nutritionists. In the financial sector, HDFC Bank has deployed its EVA virtual assistant to handle complex customer queries instantly. This is not just a basic chatbot, it is a system that understands intent, reduces operational costs, and keeps the customer engaged within the ecosystem. Think of it this way, you open your phone to order food. Everyday services like Zomato and Blinkit are utilizing artificial intelligence right now to route physical logistics. They use advanced predictive models to anticipate inventory needs in local dark stores and analyze real-time traffic patterns. This is the exact technology enabling those 10-minute urban deliveries. It is not just software, it is software moving physical goods in the real world efficiently. And this is the part most investors overlook. It is not just private companies making these moves. The National Payments Corporation of India, or NPCI, has partnered with NVIDIA to upgrade our unified payments interface. They are integrating artificial intelligence for real-time fraud checks across the infrastructure. Imagine the sheer volume of UPI transactions happening every second. Artificial intelligence is sitting in the background, analyzing patterns, spotting anomalies, and preventing fraud before the money even leaves your account. Furthermore, we are seeing the rise of autonomous agentic payments, where the system can intelligently execute recurring mandates or smart transactions on your behalf safely and securely. But most people stop here, assuming India only outsources technology and does not build core artificial intelligence models. That is a massive mistake. Let us look at what the data actually shows. In February 2026, India hosted the historic India AI Impact Summit. This was not just a talking shop. This summit drew over $200 billion in commitments to build indigenous, sovereign artificial intelligence infrastructure. The government and private sector are treating artificial intelligence infrastructure as a digital public good. The goal is to give Indian startups affordable computing power, much like how the government built the digital public infrastructure for UPI and Aadhaar. This directly busts another common myth, the idea that this technology only works for English speakers. Sovereign models like Kritrim, built by Ola, and Sarvam AI are being natively trained on 22 official Indian languages. They are designed from the ground up to serve the local population, understanding the nuances of Hindi, Marathi, Tamil, and Bengali. This opens up digital services to hundreds of millions of Indians in Tier 2 and Tier 3 cities, creating a massive new market for tech companies. Of course, with rapid growth comes the need for guardrails. The new information technology rules introduced in February 2026 mandate strict platform compliance, including a 3-hour takedown window for deepfakes. This regulatory clarity is actually good for the markets. When the Securities and Exchange Board of India or the Ministry of Electronics and Information Technology step in to create clear rules, it reduces uncertainty. It forces platforms to build robust automated moderation systems, which in turn makes the ecosystem safer for consumers and more predictable for institutional investors. Let us look at enterprise efficiency. Zomato has recently unveiled a platform called Nugget, an AI-powered customer support system. Alongside companies like Core.ai, these platforms are drastically reducing enterprise support costs. They deploy autonomous voice and chat agents that can resolve up to 80% of routine queries without human intervention. When a company reduces its customer acquisition and support costs, those savings eventually flow down to the bottom line, improving profit margins. For an investor analyzing a corporate balance sheet, improving margins driven by technological efficiency is a very strong signal. So, what does this mean for retail investors like you and me who want exposure to this growth? You don't need to be a venture capitalist writing million-dollar checks to startups. Retail investors can gain exposure through specific mutual funds and exchange-traded funds. For global exposure, something like the Mirai Asset FANG Plus ETF gives you a slice of the global technology giants building the foundational models and hardware. For domestic exposure, funds like the Tata Digital India Fund focus on the Indian technology sector, capturing the companies that are applying this technology locally. These are things worth knowing. Historically, what tends to happen in technology cycles is that the hardware companies make the money first, followed by the infrastructure builders, and finally the application layer companies. We are now entering that application phase. The insight here is that you don't need to invest in a company that is purely building AI. You can look for traditional businesses, whether in banking, logistics, or retail, that are aggressively adopting these tools to widen their economic moat and outpace their competitors. What this means is that your investment strategy should start looking at technology adoption as a key metric. When you read an annual report or listen to an earnings call, pay attention to management discussing how they are using these tools to reduce costs or drive sales. The companies that fail to adopt these Layer 5 applications will likely see their margins compress and their market share erode over the next 3 to 5 years. Everything we have covered today is purely for learning. Your financial decisions should always be based on your own independent research and, if needed, guidance from a qualified advisor. Please subscribe, leave a comment with your questions, and share this with someone who really needs to hear this. This is Ishwar from Paisa Forever.